Good morning, everyone, and it's a pleasure to again be here. I was here last year, again be here. I think it's a wonderful day. So today I'm going to talk about alpha generation, right? How do we generate alpha? Because that's the essence of investment management, right? And over the years, if you look at it, we've seen that funds have been difficult. When you say alpha means what? How much excess return you generate over the benchmark. And it's been a tough in terms of beating the benchmark. And we've seen emergence of passive funds coming up. And it's a threat to us really, right? For the active fund managers, even for you. And so it's very important to understand the process, okay? How do we generate alpha and continue to sustain that? Then only probably we'll get the inflows what we are getting on the mutual fund side. So I'll take you through our process. So if you look at alpha generation, right, can be divided from three parts. It comes. One is asset allocation, right, which is what how do you allocate across various asset classes. This is what you do in a way, right? You try to generate alpha for your clients in terms of deciding in which fund to invest, equity, debt, gold, and to do that at the portfolio level. The second source of alpha is in terms of top-down, right, view, macro view, and sector selection. How do you allocate between various sectors? And the third source of alpha in a fund for us is through bottom-up stock selection. How do you select stocks? How much do we allocate to that? So I'll take you through each of these. So asset allocation, this is something which is more appropriate for us from the mutual fund side in the hybrid funds, right? Or the asset allocation fund, the fund of funds which we have. So it's a combination of a qualitative as well as a quantitative process, okay, which is there. So we have a regular meetings, like once in 2 months, okay, where the equity, the debt team, the commodities, arbitrage, we all sit together and we discuss in terms of what is the outlook for each of the asset classes, and then try to arrive in terms of where do you need to increase or when you decrease the allocation over there. We also have a quantitative model and kind of a guide rails which are there. Like for our hybrid funds, it's also important to have a risk framework in place in terms of how much risk you take. Like for the debt in asset allocation in a hybrid fund is supposed to provide you safety, right, when there's market volatility. So it's important to have guide rails in terms of what is the kind of risk you take. So we've clearly defined guidelines that we will not take any credit risk, okay, maximum AAA, AA kind of a paper, and not any duration risk. In the past, we have done that and people have burned their fingers. And the quantitative model is really the basis, right? This is a model which we have fine-tuned over a period of time. In the last 1 year, this model has gone through a development, and we have added various parameters to that. So it's an 8-factor model which we do, which has got valuation parameters, which is like price to earnings, price to book value, right, yield gap, to decide how the market is, whether it is expensive related to its historical or whether it is cheap. So if you look at currently, the market on a price to earnings multiple, okay, Nifty, is slightly below the long-term average or near that. What has happened, the market was expensive around 2 years back, but in the last 2 years, if you look at, earnings have grown by almost 30%, and the market is more or less flat, Nifty, right, in October 21. So it is slightly attractive, right, on a yield gap basis if you look at it, because the bond yields have gone up significantly. Yield gap, it is not as attractive. We also look at to also take care of the short-term movements in the market, right, which is there, right, because normally valuation parameters don't change too much. We also look at the momentum indicators, which we have added in the last 1 year, which has helped us to take short-term actions, like whether the momentum is positive or the momentum is reversing. Or we also found out copper to gold ratio, which also tells us whether there is risk on. Whenever there is more momentum in the market, we see copper really goes up, right? And copper to gold ratio goes up. Also, volatility ratios, right? VIX, as you know, right, which determines the market volatility. That is also indication in terms of how the market movements could be in the shorter term. So both domestic and this thing. And this is the model, okay, which we are using for our balanced advantage fund, right, which has done well. And also for all other hybrid funds, okay, where we take a call in terms of how much equity exposure we need to take or reduce that. The top-down view also is important, right, when we take, so it's a, in the top-down will be the global macro view. I think what we have seen, especially after the global financial crisis, and what we realize, that the financial market is all interconnected, right? Anything which happens globally can impact our markets, and especially how interest rate movements move, how liquidity changes globally can impact the market. So it's very important to really analyze that, right? After the global financial crisis, we saw that when the economy went down, the central banks came together, they reduced interest rates to almost zero and pumped in huge amount of liquidity. And then we saw the markets reflated. Nobody expected a market to really bounce back so much, right? And since then, we have seen the financial conditions have been fairly easy. So if you're able to analyze that, right, what's happening and tracking that, then you can take accordingly positions, okay, in your portfolio. Similar case like during the taper tantrum, right? In 2013, when we saw that the Fed said that they will want to withdraw the easy liquidity which was there and increase interest rates, right? We saw a sharp correction in the markets at that point in time. You will all remember that period, right? So I think understanding some of these movements, okay, what's happening in the global macro is also important, and we have a process around that to really track that on a regular basis. Also, global macro, if you look at what impacts is the interest rates, right? Especially the US, right? And the other emerging markets. What is the differential between the interest rates? Okay, that also determines whether there's a risk on or risk off. So for the better period after the global financial crisis, we've seen that the US interest rates have been very, very low, right? So the differential between the US interest rates and the emerging markets, or this is, in this case, it is India specifically over here, you can see is very large. And these have been periods where typically it has been a risk on. Financial conditions have been easy, right? Markets have done well, especially the global markets which have done well, right? And more recently, if you look at it, right, we've seen that the spreads have compressed. Because why? We have seen that because of higher inflation and this thing, Fed has been in a tightening mode in the last 2 years. And that gap is now around 2.6%. And that's been a risk off. That's why we are seeing that this is a period where when US interest rates go up, US dollar strengthens, and there is a outflow of money, okay, from risk assets, especially equity and emerging markets. And as a result of that, we have seen in the last 2 years, last calendar year, we saw maximum amount of FI outflows, right? Almost like $26 billion. And this year also we have seen in the last, again, 2 years, again, when the US bond has hit around 5%, we have seen FIs have been selling. So that's also important to really monitor. And then financial conditions, right? So there is a financial condition index which we look at, which tells us, okay, which is a combination of various factors: interest rates, the exchange rate which is there, the liquidity, the credit spreads. When financial conditions are tighter, right, there's a risk of, and markets tend to correct. So in the last 2 years, we have seen that the financial conditions have kind of tightened, right? And that's the reason why we've seen correction, okay, in the global markets. And then the domestic view, right? Domestic macro also, okay, we have, because that is important. While global macro impacts the liquidity and capital flows, because FIs are a dominant factor, domestic macro determines in terms of how well the economy is doing, right? So when you look at our economy, right, India, we think that a lot of factors are now, structural factors are in place at this point in time. After a long time, actually, I'm seeing a sustainable, at least you can now believe that Indian economy can go on a sustainable basis. And the reasons for that are, A, we have seen large reforms, okay, in the last 7-8 years. That has laid the foundation, okay, for the economy to sustain, whether it is in the banking and financial sector reform, which we saw, the GST implementation, the Aadhaar, UPI, the real estate sector reforms. So all that has set the foundation, and obviously demographic dividend which is there in place, right? In the earlier slide also, earlier speaker talked about how India will have that demographic dividend for the next 30 years. We have the largest working age population which is there in the world. And if that is really driven properly, and that can lead to India becoming a large domestic manufacturing hub, right? There's a time now where India can take that place, because globally, geopolitics where they are, people are trying to move away from China, right? And at this moment, if we're able to establish that position, okay, we can really give a good momentum to our GDP, right? So, and government has also realized that we are seeing a big investments happening in logistics, trying to reduce your logistics costs. There's a tax incentive which has been given, and a lot of global MNC companies are now, okay, looking to redefine their supply chain, right? And India can play a very important role. And recently we have seen many multinational companies trying to set up base in India. In the mobile phone, for example, if you look at India has now become a net exporter of mobile phones. So all this thing is going to drive our economy, right, on a longer term basis, sustain a GDP of around 6.5–7% or so. And most importantly, this is a world, okay, where technology is going to play a very important role than what it happened in the earlier years. And India is well placed in this digital world. We are not only suppliers of talent to the global, but internally also adoption of technology, especially COVID, if you see in India, has happened in a much better way. So these will be the blocks, okay, which will sustain our economy at a much longer pace. And this is a more global, long-term macro view, okay, which one has to take. And that's why people have started talking about whether India will become the third largest economy. not only third largest economy, but also the second largest economy, right? Overtaking US in the next 50 years. Goldman Sachs has come with a report. So in the domestic macro view remains fairly strong, and that is going to really, for long-term investors, okay, that is what want, because if economy grows, your earnings will grow, right, and markets will do better. At the same time, we also look at sector allocation, right? Within the sectors, how do you allocate? Because that's again a source of alpha for us, right? So if you look at the broader sectors, broadly how we define our framework is that we define into two buckets. One is the defensive sectors, right? So defensive sectors are what? FMCG, utilities, healthcare, telecom, okay, are the defensive, and then the non-defensive is cyclicals, as you call, right? Which is typically the capital goods sector, the financial sector, the commodity sectors, consumer durables. And if you understand the business cycles, right, how do they do, and play that, then you can decide which sectors you need to be overweight or underweight. So the broad framework what we have over here is that, for example, if the economy is kind of moving from a contraction place into a slump, right? When the economies are down, like during COVID, right? We saw the economy suddenly went, okay, contracted severely, right? And went to a slump. That's the time you want to be maximum, right? In that period, overweight into non-defensives, right? Because economy has bottomed out. Okay, when it reflates back, you will see the cyclicals or the non-defensives will do well, and you want to be underweight the defensives. Slowly, as the economy moves from slump to expansion phase, right, in that transition which has happened is coming out of that phase, okay, you will move from non-defensives which you are overweight to kind of moderate, and you will have equal balance between defensives and non-defensives. This is the current phase in the economy where we are, we think, right? We have come out from that bottom, we have seen the economic recovery, we are still not at the peak of the economic growth, right? We are still somewhere in between. So you have a right balance between defensives and non-defensives. Again, from expansion, okay, when you reach to a peak, which potentially could happen in the next 2-3 years, your economy could again gain momentum, right? That's the time you want to be cautious. You want to move from the non-defensive or cyclicals to into more defensive, because you want to protect, right? Where the impact of any slump, because we know economies go through this cycle. And that's how this transition, okay, we play and try to decide, okay, where, how do we allocate between various sectors. Again, another framework which we have for sector allocation is also to look at, while we know the economic cycle and this correlation between the various sectors, but within individual sectors, because within defenses there are many other sectors which are there, right? Or the non-defensives. What is the outlook for that sector? When I say outlook for the sector, means whether the sector is going to grow faster than the overall GDP growth, and there are key drivers for that. Like for example, currently if you look at sectors like industrials or the capital goods sector, right, is seeing a good traction, because we are coming out of a long period where capex has been down, and the outlook looks promising over there. We are seeing a revival of the capex cycle. Sector like real estate, for example, right? After again from 2013 to 2020, we have seen a large slowdown, and we are seeing the sector again reviving back. The outlook is good. The sales happening are very good over there. Inventory levels are low. And then you look at the valuations, right? Where the valuations are for that sector relative to its historical average, right? Where it is. So if you, the best place is where the outlook is good, right? Outlook means the sector is likely to grow faster, right? There are drivers to that. And the valuations, okay, are relatively attractive vis-a-vis historical levels, right? That's where you look at it. Like for example, here, like sectors like energy, for example, right? Which is there, or other utilities, where the outlook is improving, because India is getting into a phase where you will see peak shortages. We haven't invested in the power sector for a long period of time, right? So the outlook should be good, and valuations are very reasonable. There could be the other case where the outlook is good, right? But the valuations are still higher. In that sector, we'll still be overweight or positive, because even the valuations are higher, they can continue to do well, right? So for example, in the industrial and capital goods sector at this point in time, the outlook is good, improving, but the valuation is also high. A lot of these stocks are expensive, so you will be slightly cautious there, but we still continue to hold that. And the sectors to avoid is where the valuations are higher, right? High, and the outlook also is kind of deteriorating. That's where you want to get out and be significant underweight. That's the kind of a framework, okay, which we use for sector allocation. Again, this is a chart. Again, we also look at profit pools, how they are changing. So we look at, say, if you look at the top 1,000 companies, right, sector-wise, okay, what are the profit pools and how they are changing? Because there is a cyclicality in profits across sectors, right, which is there, and how the market cap cohorts are changing. This is a combination also framework which we use to decide if the profit pools are increasing and the market cap is not showing that, that means there's the biggest opportunity because the profits are increasing but market is not recognizing that. So that's one way to look at this framework. Again, this is slightly complicated, I won't really get into this. And if you really crystallize that, right, how that works for us. So currently, if you look at our fund house view, is that there is a slight risk off because from a global macro standpoint, because interest rates are higher and going to remain higher for a longer period of time. And you will see FII flows, okay, slightly. Only recently we saw last few days, your US 10-year has kind of contracted after the Fed policy. So there could be, again, some amount of risk on the short-term basis. Again, we also look at from top-down, like styles, how they are performing, right? We know that styles also impact in terms of how the stocks do well, right? For example, in the 18-19 period, growth style did very well. It was growth at any price. You saw a lot of these growth stocks, okay, going higher and became more expensive. Last 1.5 years, that interest rates moved up, we've seen value has done very well, right? So a lot of these value stocks, the PSUs of this thing, the value funds have given fantastic returns. I think now as interest rates peak out, we think that growth again will slowly start to re-emerge, right? A lot of the growth stocks are now corrected, okay, where the valuations have come down. So that's how also we look at styles, okay, how it can play and take a tilt. So now our tilt will be more towards moving from value stocks towards growth stocks slowly as interest rates kind of come off. And because of our view that the domestic macro is good, right, is very strong compared to global where the growth could get impacted, we are more overweight domestic sectors, right, whether it is banking and financials, whether it is the real estate sector, whether it is the automobile sector is where we are positive with. And some of the key things of interest for us at this point in time which we like are private banks and NBFCs because we think that the sector has valuations are now reasonable. It hasn't done as well. Okay, outlook is good. Overall profitability for the sector, we are going through a very kind of a good credit cycle where the NPAs are very, very benign. Also discretionary consumption. While the sector has not done well, outlook recently has been bad, but we think that with the India's per capita income going up, with premiumization happening, discretionary consumption can be a long-term theme, right, which will be there. So discretionary consumption means what you spend, right, on besides your normal regular FMCG, apparel, retail, consumer durable companies, QSR companies, and this is a kind of a multi-decade story which will drive as per capita income goes up, premiumization happens. Manufacturing again is the theme which we talked about, okay, which is a positive one. Transportation logistics again is a theme which we think India is poised where penetration, right, of the sector, okay, will improve. There's a premiumization which is happening, and also export opportunities which are there on the auto ancillary space. So these are some of the sectors, okay, which we like. And then on the bottom-up process, because that's again bulk of the alpha comes. Normally, if you look at while industry is what we talked about, on the bottom-up side, it's about the business really, right? Focusing on the businesses, trying to look at companies or businesses, okay, which are likely to grow faster, or companies, because you want to buy companies which their earnings growth is going to be better than the nominal GDP growth, right? And companies which generate good cash flows, right? Good return on capital employed on over a business cycle. So that's what we would look at. Also companies which are able to delever, right? Where the leverage is low, typically that's what you want to invest into. And also when you're looking at a company bottom up, management also is very, very important, right? Because we've seen that over a period of time, management, if you're betting on the right management or the right leaders, automatically they will work for you. So a process to really evaluate management, okay, is something which we have incorporated. How do we evaluate management? Which are the good management? What is the kind of capital allocation decisions the managements are making, where they're making the right capital allocation decisions? That's also equally important in our stock selection process. So the key to stock selection is to get early, right? You want to be early and ahead of the market, and that's where you can really play the whole cycle well. And that requires a lot of ground research, right? On the ground research, okay, where you have independent sources of getting information. Focus on long-term compounded winners, because you also want to have stocks which will continue. Once you buy that stock, you want to really hold it from a longer-term perspective. And also look at triggers, okay, which could be there, which can enhance value from a short term. So, for example, in a company like NTPC, which was there kind of flat for a long period of time, suddenly, okay, when they started talking about green energy, right, getting into solar, that made a pivot and we saw a re-rating of that company. So what are the triggers in the stock is something which we look at. And finally, it's about avoiding mistakes, right? So while we look at companies, we are okay to miss out many companies, right? So when you research say 10 companies, we'll probably miss out 7 companies, right? Especially in the small cap space, because we really want to put in money where your conviction is the highest, where the confidence is the highest. And this is the kind of a framework which we have internally for idea generation and evaluation. So there are various filters, okay, which ideas information will come in through screeners, okay, through industry sources, from sell-side research. And once we filtered and shortlisted ideas, then the analyst, okay, he works on the ideas, does the research, he presents the idea internally to the whole team, and we discuss and debate within the whole team and see whether this idea makes sense, okay, whether the idea gets accepted as a good idea. If it does, then it becomes part of our portfolio or a part of our investment universe. Otherwise, it gets rejected. And this whole process goes on. Currently, we have around 460 companies which are part of our investment universe, which is there. Besides numbers, okay, what we have realized that besides valuation, it's also important to understand what is the story behind a company, what is the narrative behind a stock. That also is very important, because it's not only about valuations, and that is something which we have learned over a period of time. So we have built these 8 narratives. For example, a company could fall under established compounder, means the earnings are continuously compounding steadily over a year. Typically, blue chip companies like Lever, for example, right, or Nestle or HDFC Bank, they have been compounding the earnings steadily. And these companies, you will never get it cheap. There will always be a premium for that, which will be there, right? And you should understand that they will be slightly expensive. The second category could be small size, big opportunity. What it means is that currently the company is small, but the overall addressable market is very large. A case like Titan, for example, in the jewelry space. So the retail jewelry space is a very large unorganized market which is there, right? And Titan has been able to gain market share. So these companies will have a very high growth and a longevity of growth, right? So there will always be, there is always a premium. So these companies, you will never get it cheap. So you have to put that in your mind, okay, when you're looking at this company. A second narrative could be visionary leadership, right? Here, the management or the promoters, okay, have the vision to pivot their business, right? To reorient their business depending on the market conditions. And so that something which you can never capture in numbers. A case example here is like Tube Investments, right? So Mr. Vellayan, when he came in, okay, and joined as a leader over here, he transformed this company. Tube Investment was a company which was making just tubes for cycles, right? But he transformed these companies, okay, into various other businesses, like a P investor. They acquired a company like Crompton Greaves. So that could have never been captured in the numbers. So you have to pay a premium again for that. Secondly, category disruptors, right? It's all these new age technology companies which have come in recently. The way to look at that framework is, if you look at on the current, a lot of the companies in Twitter, they say that the multiples are very, very high because they don't have any profitability. But they are disruptors. They're investing and disrupting. And once they do that, the future, okay, they can capture the market much faster. So there is a different way of looking at these companies. Similarly, deep value. So value can remain value for a long period of time. Like we saw a lot of these PSUs or NTPC. For 10 years, they didn't do anything, right? And suddenly in the last 2 years, we've seen the stocks kind of double or triple over there. So when you look at value investing, you look at what are the triggers which will unlock value from there, right? That's where you come in over there. So all these narratives, okay, when we build and slot companies, we can better appreciate in terms of, again, how do you want to look at those besides the normal numbers. So this is a framework which we have done, which also helps us in terms of identifying stocks. And then we have build conviction in those ideas, right? So how do we build conviction? So we have 3-year ideas coming in from analysts, okay, which are long-term ideas, because sometimes you miss out companies on a 1-year basis. And we got model portfolios for large caps, mid caps, okay, and small caps. So out of a universe of around 460, 500 companies, ideally is to get which are the top high conviction ideas coming in, which will be around 120, around 1/3 or 25% of the stocks, where we want to build ownership. And if you get that right, see, ideally we don't, in a portfolio, even if you get around 55 to 60% of your ideas right with proper allocation, you are done, right? That can generate significant alpha. That's normally a hit rate will never be more than around 60%. And that's the, if you're able to do that, okay, then we can able to generate the alpha in our portfolios. This is just an illustration I thought to show that how based on a top-down macro analysis and domestic, we found that the transportation and logistics sector, okay, is a good sector, okay, which will have a good prospects because of penetration levels increasing, premiumization happening over there, the export story, okay, which is likely to pan out. And we looked at this sector and decided to be overweight. And then within that space, auto ancillary is a sector which we found that can have got multiple drivers, right? Because companies are trying to diversify right, enter into newer products which can give them a higher growth. The whole EV transition is also providing new opportunities for companies which are able to capture that. And the whole China Plus One export story, because what is happening in Europe is that because of the higher manpower costs and the energy costs, a lot of auto ancillaries are in bad shape. They're closing down. And Indian auto ancillary companies, exporters, are able to really gain market share, or they're able to acquire that. So that was the kind of a broad thesis. And just to illustrate an example, then we focused on a company like Craftsman Automation around 2 years back, right? So this company was essentially catered only to the CV market, right? They were into the ferrous castings. And this company then diversified, right? They saw opportunity in the two-wheelers and the four-wheeler space into aluminum castings, right? Which is, again, a slightly high-end kind of a thing. And especially with EV coming in, there's a lot of lightweighting of vehicles which is required, right? So aluminum castings really come in demand. And as a result, the company would, while the industry just grew at around whatever 10%, that turnover or the revenues for this company grow multiple, and that's how, okay, this stock has done well. So just to take you through all the example, how the domestic macro and how do we really do at bottom of stock picking. And finally, I think while we want to generate alpha, right, it's also important to understand the risk what you're taking, right? Because if you don't do that, then you'll not always get things right, right? It can backfire. The first thing is in terms of conviction, okay, what you want to own, right? So for that, we have a risk grading framework, which is there in the management scorecard that will decide whether you really want to own that stock. Because if the management quality is below a particular threshold, right, even if the outlook might look good, okay, we don't want to get into that stock because somewhere down the line, okay, it will falter. So that's the framework. Second is in terms of sizing the opportunity, how much you want to own. Even if you like a company, right, very much, depending on the liquidity, right, and the risk, okay, we will measure our exposure to that company. So we have got clear guide rails at the portfolio level, right? So both at the stock level and also at the sector level, right? Because at the end of it, we want to only generate enough alpha. Because if you take higher risk, you will generate a huge alpha in a particular period or a particular year. But say probably a couple of years down the line, okay, there will be serious underperformance also which is there, right? So it's important to take measured risk in a portfolio, both at the stock and the sector levels, so that you ensure that there is more sustainability of alpha generation which is there. So we have clear guide rails in terms of what is the active weight you will have at a stock level or a sector level, so that you generate alpha on a more consistent basis. And finally is when do you sell, right? Because that is also important decision, right? You generate an alpha, when do you sell? So normally, whenever there is a change in the hypothesis, okay, which we have bought the stock, or the change in the business conditions is where one would sell. Obviously, if the stock valuations have also gone up significantly, okay, you'll normally not exit the stock, but you'll trim it down. So with this kind of a framework in place, we think that the alpha generation, okay, what we are talking about, right, is something which everybody tries to generate alpha, but we can also do it on a much more sustainable basis. Because finally, for investors, okay, what we do is to give more consistent performance. We believe that trying to chase performance, right, and trying to be the top is not something which you can do every time. But if you have a proper process around that and with the proper risk framework, okay, then the journey can be smooth for investors and everyone. And I think going forward, I think we have realized that the alpha in the market, right, especially for larger cap funds, if you look at it, I mean, earlier in the last 4 or 5 years back, we could easily generate around 3 to 4, 5% alpha. Now we are targeting that, okay, if we generate even a 1-2% alpha, say for a large cap fund, okay, that's good enough. Because if you're competing with, say, ETFs, right, then if we will demonstrate that you can generate that much alpha, then the money can come back. So that's the whole framework which we wanted to discuss over here. So I think we have done. I think the time is up. I won't move ahead. These are some of the learnings, okay, which we had over a period of time and which we have tried to incorporate in our whole framework.